All righty. Welcome everybody to the Investment Strategies for Concentrated Positions workshop. This is part of our summer seminar series. It started with our Don't Blow Your IPO workshop, followed by the short-term rental and tax plan workshop from about a week ago. And then stay tuned. In about 2 weeks, we'll have our philanthropic planning workshop. I am Sam Boyd, founder and president of Confident Advice Investments. And I am joined by a handful of my esteemed colleagues from the Mariner home office. First up, we've got Brett Kunchik. He's the head of options and structured notes at Mariner. He's going to be helping us out with our options and variable prepaid forward contract discussion. We also have Sean Newkirk with us, who's the senior manager of MPEP, of Mariner's personalized equity portfolios, our direct indexing strategy. We also have Martin Chong with us, who's a investment strategy consultant with Mariner and covers a whole bunch of different components of sort of the investment landscape. And so does our other colleague, Piper Leach, who's an investment analyst. So thank you guys all for joining us. We're happy to have you. And so with that, we will jump forward into some housekeeping. Got our disclosures here. And then if you have any questions, go ahead and use the Zoom Q&A feature. You can just plug your questions in there. I'll try to pick them up as we're going through. But if I don't get to it, I'll try to get them all at the end of the presentation. So with that, so we're talking about concentrated positions today. And really the sort of the name of the game with a concentrated, usually highly appreciated position is diversification, right? There are two sort of main reasons for diversification. The first is goals-based planning, right? Like, what is the role of this money in your life? What's the purpose? Is it financial independence, right? How much do you need in assets or income streams to be working because you want to, not because you have to, or not working at all, right? Cash flow planning is another big one, right? So how do we make liquidity available for, supplementing income for mortgage payments, maxing out 401k, make a backdoor Roth, et cetera. But these are all great savings vehicles, most of which with tax preferential treatment. How do we unlock resources to maximize those things? There's of course, your sort of hard and fast goals, right? Home purchases, funding education, perhaps you have family members that you want to support. There's of course tax planning, right? So, when you're diversifying, typically there's taxes involved. What do we owe now and that we need to be prepared for? And then what are we doing in terms of thinking about an annual capital gains budget? How do we put a framework around realizing taxes over time to diversify a position? Next up is philanthropic planning. If that's important to you, how much do we want to make available for philanthropy? And when? Is it now, right? Is it posthumously? And then to whom and how is it delivered, right? There's all sorts of different planning, components that come into to philanthropy and trying to make the most of it from both a tax perspective, but also an impact perspective. And then in the case of employees with equity compensation, typically we still have some equity comp on the table, whether it's incentive stock options or not qualified stock options. There's an ongoing monetization plan that we have to be thinking about in terms of, exercising the shares, right? Whether that's, we're paying to exercise them, we're doing a cashless exercise, but also covering the taxes, right? As a component of that. So, what are your goals? What's the role of the money, right? And how do we bring it into sort of real world outcomes for you? The other part of diversification is, of course, risk management, right? Concentrated positions can be risky. This is the sort of all your eggs in one basket analogy. And so we put a couple of numbers to this, which I'll just sort of rattle off. But looking at the Russell 3000, so 3,000 U.S. companies, small, medium, and large, going back from 86 to 2023. The stats are 99% of the Russell 3000 stocks had lifetime realized volatility greater than the index's volatility. So that means that the individual stock, right, just the one stock, is going to be more volatile than the index itself, which makes sense, right? Because you're smoothing the volatility over 3,000 positions in the index. Next up, 31%. The median stock in the Russell 3000 had a 31% chance of losing more than 30% of its value in 1 year, versus a 5% chance for the Russell 3000. So in other words, a 5% chance of losing 30% in any given year for the index versus about a third, 31% chance for individual stock, the median stock. Next up, 41% of Russell 3000 stocks suffered permanent impairment, right? So they never got back to their highs, right? And that's not a small number, right? 41% that's a big percent. 23% of Russell 3000 stocks lost more than a fifth of their value in an average calendar year. Again, highly volatile, all your eggs in one basket. And then 3.3 times the median stock was more than three times as volatile as the index. So for all those reasons, concentrating into one position, it can come along with pretty significant risk and significant volatility. So combination of things, goals-based planning, but also risk management. So what do we do about it, right? How do we unwind these often low basis, highly appreciated, concentrated positions? So what I have on the slide here is sort of a comparison of a bunch of different things that we're going to go much deeper on as we move through the presentation. And I'll just kind of give some highlights here. And then as we go through, we'll go deeper, into each strategy. So of course, one option is sell, an outright sale. Just sell the stock and pay the taxes. It is elegant in its simplicity, but not and risk management for that matter, but not on the tax side, right? So if you do an outright sale, you're going to pay the piper, when tax time comes. Another option that we talk a lot about is direct indexing. Direct indexing is, and we'll go deeper into how it works, but this is usually better for a smaller concentrated position. With a direct index, if you want to follow the index without a huge tracking error, you're going to have to, either add cash to the portfolio, right, or diversify some portion of that original position, so that you can actually end up with an index tracking portfolio. Direct indexing is at the core of our sort of non-retirement after-tax investment philosophy. But generally better for a smaller concentrated position when you've got other parts of the portfolio or cash that you can also add in. Then we get into our option strategies, and they all do sort of different things, but primarily covered calls we look at to generate income. It's not going to diversify you or provide any sort of loss reduction. It's really an income generating strategy. Whereas a collar is meant to put a floor beneath the stock that you own, right? And set a price at which you can sell it. And not to get too deep in the weeds, we'll talk more about these soon. And then of course, we've got our exchange funds. Exchange funds are a very interesting option. You can diversify, right away, essentially. But there is a catch. You've got to hold that exchange fund for 7 years before it's returned to you, and you can start to take liquidity from it and do other things. It also doesn't solve your tax problem, right? You still have your original cost basis when you go to sell, although it is diversified when it comes out of the exchange fund. And again, we'll talk more about how that works in a moment. And then there's the tax-aware long short. This is probably the most complex of the group, but this strategy is the use of leverage, using margin, taking a loan against your investment account to take a long and a short high conviction position with that margin debt. And the sort of background research on this is that it creates effectively a tax loss harvesting machine, a flywheel. That whether markets are up or down, we can tax loss harvest, create capital losses that we can then use to offset capital gains. So very fascinating. We'll talk more about it. And then last but certainly not least is variable prepaid forward contracts, or what folks in the options world would call a collar advance, which allow us to get liquidity from a concentrated position without selling it and without realizing the taxes. And you can use that liquidity to then implement some of these other strategies that can create a really compelling sort of mosaic of approaches to managing risk and reaching your goals. So very broad, high-level overview. We will dig deeper here as we go. So the most straightforward outright sale, right? We don't need to get too deep into what that means, right? You were hitting the sell button, and now your stock is sold, and now you have realized gains as a result, right? So, what do we do sort of after the fact or in the process? What I've got on the screen are a handful of planning opportunities. So uh, if you've made a large, significant sale and you've got a large, capital gain, one option would be to use a charitable deduction. And so donor advised fund is a very simple, very straightforward way to get a charitable deduction, whether it's cash or it's the appreciated security itself. You can transfer the stock in kind into the donor advised fund. So long as you've held it for a year and a day and it's long-term capital gain, you get a deduction, charitable deduction for the fair market value of the stock. When it's sold, you don't realize the gain because it's inside the donor advised fund, right? And then from that point, you have to then give that money to charity, right? Um, the donor advised fund is very simple and like I said, very very straightforward. But it really only makes sense if you already plan to give to charity, right? Like you have to that has to be part of your broader framework of planning goals because it has to go to charity from that point forward. Um, the charitable remainder unit trust or the CRUT or the NIM CRUT or flip CRUT is a little bit more complex, but a really, really interesting tool. And again, we're doing a workshop on these topics in about 2 weeks if you're interested. But with the CRUD or the NIM CRUD, you would take the appreciated stock, you'd contribute it into the CRUD. You get a tax deduction at that point, not for the full fair market value like the donor advised fund, but it's going to be based on your age and your payment rights. So let's just say 10%, right? So on $1 million contribution, $100,000 tax deduction, a charitable deduction, itemized deduction. Uh, Once it's inside the CRUD, it's sold and no taxes are due at that point. And then you're given payment rights, right? Which is also based on your age. So say, if you're in your, 30s, 40s, let's say 6% payment rights, that means that you can take out of that million, 6% or $60,000, or whatever, 6% or whatever the December 31st value was, and use it however you want, right? Use it to supplement income, use it to, make larger 401k or, make a backdoor Roth contributions, offset, mortgage cost. You're going to realize the taxable income as you take those distributions. Usually it's taxed as it went in, so long-term capital gains. Um, but you'd be able to diversify immediately, take a deduction at the point of the contribution, right? And then also create an income stream, that you could then use going forward. A couple other notes on this: the NIM in NIM CRUT stands for net income with makeup. And what that means is that you can stack your payment rights. So if you don't take 6 in the first year, take 12 in the next, right? If you don't take it in the second year, 18% out in the third, 24 in the fourth, so on and so on. So if you set something like this up, but you still plan to work and you don't need the income, right? You're not losing out on those years that you had payment rights and didn't take them in an IMCRUD. You're just stacking those up, for the future, which could be useful if you plan for financial independence before, say, age 59 and a half. Your NIMCRUD could help bridge the gap for income planning before you start taking distributions from, say, an IRA or a 401k. One final note on the donor advised fund, or two thoughts. One is usually what we do with the donor advised fund is what's called charitable bunching, right? So, we would say, how much do we plan to give to charity in a given year? And then we would make, several years worth of contributions all in one shot, right? So that you're getting the benefit all at once, instead of spreading that out against your standard deduction. And what we always counsel people is if you plan to be philanthropic, you should be making your charitable contributions in your highest income tax years, your peak income tax years, for the charitable gifts that you plan to bequest later in life, right? So in your 40s and 50s, we're making the contributions that we plan to actually give to charity in our 60s and 70s. So past that, we've got capital loss stacking. We're going to talk more about this, but with direct indexing, and then also with taxable long short, we can try to stack up capital losses and carry those forward into the future. You can use $3,000 of capital losses against all of your income in a given year, but anything that isn't used, you carry forward. And so if you're able to stack capital losses for 1 or 2 or 3 or 4 years in size, in that third or fourth year, you could realize capital gains and have a pretty elegant solution, for not having to, recognize taxable income at that point. So capital loss stacking, we'll talk more about this with variable prepaid forward contracts and taxable long short, but very effective tactic for an outright sale. We talked about this last week, but one of the biggest sort of opportunities for tax planning, especially retroactively, right now is short-term rental, bonus depreciation, cost segregation. I won't get too deep into this. I can send you the replay link for the last webinar, but normally rental real estate is considered per se passive by the IRS, which means you can only take passive losses against passive income. The short-term rental is different. It's got a different set of rules and tests associated with it, where if you're offering significant services, AKA like an Airbnb or VRBO, and you've got 100 hours, average stay of 7 days or less, and no other person or business had more service than yourself in that year, not every single year, but in that year, it's not considered passive, and you can use losses to offset your other income, including capital gain income. We couple that with the Big Beautiful Bill, which just brought back bonus depreciation. You're able to depreciate any component of the structure that has, we call it short life, but under 27.5 year life. You can take the deduction all at once. And so, in practice, having done like 9 dozen of these in the past, few years, somewhere between 20 and 35% of the purchase price, we should be able to take as a loss in year one. So on $1 million property, $200,000 to $350,000. Pretty effective, but you also have to want to be a landlord, right? So certainly not for everybody. That is not like a passive strategy. And then of course, the sort of more straightforward ones, of course, tax deferral opportunities, 401k contributions, health savings accounts. These will help bring down the tax that's due retroactively on an outright sale. And if you just sold a bunch of stock and now you have cash, but you don't have the cash flow to max out your 401k, well, you can do some paycheck replacement, right? Replace the money that you're losing in your paycheck with the cash that came from the sale. That'll allow you to then max out that retirement account and get to the maximum deduction. SALT deduction opportunities, right? So the SALT cap is $40,000, state and local tax cap. So trying to maximize that, which in a year where you've got, significant realized gains is difficult, but that SALT deduction is very valuable. And so we try to maximize that. If you're self-employed, you can make an S corp election and do pass through entity tax planning. But for most people, it's just trying to manage your AGI, adjusted gross income. And then last but not least, self-employed planning opportunities where applicable. Like if you have self-employed income, you're able to take a loss for essentially, it's a little more complicated than this, but for 3 years before the IRS would consider it a hobby, where you could still, continue doing it and take a loss on it, but you can't use that loss to offset other income. The key to the hobby loss rules is that you have to have a dyed-in-the-wool profit motive for this to be kosher with the IRS. So you can lose money in the United States of America, and do so for at least 3 years. But ultimately, you do have to have a profit motive in that endeavor. So outright sale, a bunch of different strategies you can consider. But it's certainly the simplest on the front end, but there's some work to do on the back end to remediate the taxes, clearly. Okay, so next up, direct indexing. I want to turn it over to Sean on this one. Sean, talk to us about direct indexing, pros and cons, and kind of get us up to speed.
Yeah, Sam, thanks. So we think about direct indexing fairly simply. It's complicated. It can be complicated, but it's really simple if you just think about it you've got 3 ways to get access to a benchmark, right? You've got let's take the SP 500. You could buy all 500 stocks in SP 500. Why would you do that? I don't know, but you could do it. You don't get any tax benefit because once you sell a stock, you're kind of out of tracking error, and it's just not the way to do it. Far in the other spectrum is you could pay Vanguard or iShares or someone a couple basis points to do it for you. Great. It's nice. You get a single individual wrapper. You own one name. You pay them a small fee. Works perfect for an ETF, right? Still, no tax benefit because if you sell, say, SPY, go buy IVV, you have a wash sale. You're just not allowed to do that. And so where's the middle ground? And that's kind of where direct indexing comes in from a middle ground perspective of where you don't need to own all 500. You don't need to own just one security. You can own 250, 200 of them. You're still going to track the index. Now, your tracking error, how far you are from the index, is going to be a little higher than both those two outer scenarios. But you are still going to be looking for low tracking error, low cost. Typically, for many ETFs, it's as cheap or cheaper than some ETFs, just in some direct indexing products are. And so you're thinking super low tracking error, low cost, but with the tax benefit, right? If 5 or 10 stocks have dropped inside your direct indexing product, you could sell those, buy something else, capture that loss while still maintaining your exposure to the underlying index you've selected. The next benefit of, I would say, with direct indexing is you get customization. Not applicable for everybody, but in many cases it is, where you have folks who say, "Hey, I don't want to own Tesla. I don't want to own tobacco stocks," right? So you've got pretty detailed customization to the point where you can basically make an ETF for yourself, is the way to maybe think about it. And it's not just limited to the S&P. It could be the Russell 1, the Russell 3000, global exposure, you kind of name it. Even down to kind of niche benchmarks like the NASDAQ 100 index, right? And so high customization is the other, I'd say, big benefit of direct indexing. And when it comes to contrary positions too, if you've got a big, say, Microsoft position, right? If you just sold $100,000 worth of Microsoft, bought $100,000 worth of IVV, let's say, thinking like, okay, I'm going to shift some of my risk to the index. Well, you still own IVV in that, or sorry, you still own Microsoft in that ETF, right? Yes, you've lessened it a bit, but you still have exposure to that security that you're trying to de-risk from. And so a good direct indexing product should be able to, with that $100,000, let's say you sold, build a portfolio around the risk profile of your embedded gain position, right? So that you're offsetting some of that risk, not just by owning the index, but owning stocks that help kind of reduce that single concentrated risk a bit. As those stocks fluctuate, you're able to sell some of those losers, sell some of your Microsoft position in this scenario, right? And kind of keep working that down over time. So it's a great product for customization, typically low cost, and being able to kind of diversify through owning risk adjacent positions.
That's awesome, Sean. Thank you. I always like think of 2023 as a great example of when direct indexing like really shined for us, right? Because that was a year with the or, let's see, was it 23? It was a year when the market was up, but it was a Mag 7, like doing all the heavy lifting, right? And so like 493 stocks were either sideways or down, by and large, right? But the index is up. And so if you owned SPY, positive return, right? But no opportunity to get any tax benefits. Whereas if you were in S&P direct index, right, you would have had an opportunity to sell the, losers, for lack of a better word, really all throughout the year.
Yeah.
Can you talk a little bit?
2019, the Russell 3000 was up 31.1% in 2019. Yet about one third of the stocks in the Russell 3000 were down, right? And so, you could have bought the Russell 3000 ETF, had a great 31% return. I'm sure everybody would take 31% in any year. But the way to shift the thinking when it comes to a lot of tax products, not just direct indexing, is what's your post-tax return? So a really perfect direct indexing product, which probably doesn't exist, but let's just live in this hypothetical. A perfect direct indexing product returned 31% pre-tax. But with those, say, one third of those positions that were down, they were able to do something and actually outperform the ETF or the index, as you might say, post-tax, right? So 31.1% plus some tax alpha, right? So you basically outperform the index from a post-tax return just by simply owning a bunch of those other names that the ETF couldn't do anything with in that same time frame.
Yeah, and at a cost that's not too dissimilar to your point earlier. And just like to demystify this a bit, Sean, can you explain like the tax loss harvesting process, like in an example, like what is actually happening like under the hood when you identify a stock
Sure.
that you can sell at a loss? Like what does that process look like?
Yeah, so a typical direct indexing and an optimizer is kind of the general language for what that is or what's making that logic. It's typically not a human, right? It's very complicated math and kind of projecting the risk factors. But functionally, just what's happening is that, I'll give you two examples. You're tracking the SP 500 again, right? And so you've got Apple down 10%. You've got XYZ mid cap bank down 15%, or even could be down, let's just say 5%. It's easier from a tracking error standpoint, how far you are from the index. The software will generally say, hey, you know what? If I sell Apple, yeah, I get a 10% gain or loss. My tracking error maybe goes up 50 basis points. Maybe it goes up 1%, right? I take a tracking error hit for a 10% loss for that individual position. Is that worth the trade-off? Many times no. But hey, you know what? Mid-cap bank is down 5%. I could sell that. Maybe my tracking error even improves from selling it, right? Or I've got a substitute security I can easily replicate the risk of that mid-cap bank in, right? And so that's kind of what's going on under the hood. And now think of that times 200 positions times a gigantic universe of stocks to pick from, right? And so that's kind of what it's doing on these kind of scenario bases. It's not doing one for one swaps as well. I think that's a common misconception is, hey, Coke is down. I'm going to sell it by Pepsi. Really, what probably happens is it sells Coke, buys five or six other securities because it's not just looking to replicate the risk of Pepsi, but kind of any drift of any factors you've had, any other kind of risk factors that selling Coke has provided, and other some. You're typically not doing one for one trades, right? If you're rebalancing and direct indexing, you're probably doing 100 trades
Right.
at any given time.
Yeah, that would be a pretty blunt edge, the sort of Coke for Pepsi. But like the North Star is the tracking error, right?
Yep.
Is like we're trying to like what new positions would complement
Yep.
getting closer to that tracking error, sort of like the North Star.
Yep, exactly. It's a two-sided coin, I would say, where it's not just what you can sell, but what you can buy. Because it doesn't do you any good to sell something and have to sit in cash or not do anything with it if you're tracking your goes up. So,
Yeah, awesome, Sean. Thank you. So highly customizable, fairly inexpensive, and tax alpha, right? So after tax returns that can help you outperform the index on a relative basis. Uh, awesome. Okay, so let's jump into our next topic. I'm going to ask Marin, would you fill us in on tax for long short and kind of get folks up to speed on the strategy?
Course, yeah. So similar but not similar to direct indexing, it utilizes uh, you're finding basically finding positions that are have lost money. And sorry, one second, am I frozen? Can
No,
you?
I can hear you.
Okay, good. Class, show myself froze. Okay. So essentially what happens is, I guess the best way to do it is I can use an example to kind of illustrate what this means. So let's just say you have a business sale or, you stock IPO, and you have,
Oh, it froze up this time. Here, we'll see if Martin comes
$10
back.
million dollars like came, nowhere, right? So what happens is, okay, so I did
You,
froze.
you're
My
back. You're
apologies.
back now, Martin.
Okay, can you
All
hear
right,
me
go.
now?
Yeah, go ahead.
Okay. Sorry about that. All right, let me start again from the top. So text away long short. It's a fairly new, I would say, probably like within the past few years, really into the scene, and it's really designed to solve big capital gains like issues. So let's just say you have a business sale, for $10 million, or you have a stock IPO, and suddenly have just and you want to figure out, I have a very concentrated position of like a stock, or a maybe you have a big sale, a capital gain from a business sale, and you need to figure out like, all right, how do I, one, diversify that concentration, and two, how do I like kind of like generate losses in order to like wind down the position. So tax away long short, essentially, it's imagine you want to track an index, let's just say S&P 500, and what it does essentially, you are using leverage to add on long and short positions on the position, or on the index, and um and then you kind of let generate losses through that, and using the losses to wind down your concentrated position. So it is a mouthful on like how it works. I think, do we have a slide on like an illustration of like how visually how it works? I think it's just easy to explain it that way.
Yeah, we have a slide that is like sort of a comparison to ETFs and direct indexing, not the visual, but like the way that I describe it is, to your point, you're taking an index position, right? So like S&P Russell 3000, right? And then you're using leverage, you're using margin, right, to then multiply the value of that portfolio. So like, if you start with $1 million portfolio, right, you might end up with a $3 million portfolio of positions because of the margin, right? Just as an example. And so what are those other $2 million doing, right? They're taking high conviction bets essentially across different sort of pairings within that index, right? So as an example, using Coke and Pepsi, you would have like let's just say the Russell 3000 as your core, and then you would have one turn of leverage that's long, right? So you want the stock to go up, and then one turn of leverage that's short, right? That means you want the stock to go down, or you make money when the stock goes down. And so let's say over the course of that year, the Russell 3000 is up, let's just say 7%, right? But Coca-Cola is up 10 and Pepsi is up only 7, right? Well, the Pepsi position was short. So that's a loss, right? You've lost 7% on that position because you sold it short. Coca-Cola was up 10, right? So you were long that position, right? And the net of those two is +3, right? And so what you end up with is the Russell 3000's return for the year plus whatever that sort of selection alpha provided, right? So like at its core, the taxable long short is an alpha seeking strategy, not necessarily a tax, sort of remediation strategy, but as a byproduct of these high conviction long and short bets, you end up with a lot of realized losses, whether the market is up or down, right? Because it really depends on the manager you pick. Like you have to pick a manager that has done this consistently, been able to, pick these pairings, the sort of outperforming pairings, consistently over time, uh, uh, because that's really going to drive, the differential uh, between those pairings and ultimately how much alpha you get, like nominal alpha outperformance versus the benchmark, plus the tax harvesting that occurs as you close a short position or a long position as the market, sort of, does what it does. Um, and so, we use AQR as the company that we partner with to do tax for a long short. Cliff Asness is the founder. He's like the original quant, goes back a long, long time. They've got a good track record of doing this. And my understanding is it really came out of the fact that the AQR sort of manager group, when it was just an institutional strategy, they were riding along with their clients who by and large were like pension funds and, endowments and things like that. Um, but ultimately they were realizing like, a lot of the taxable income that these, 501(c)(3)s and, sort of tax-free institutions wouldn't realize in their, quantitative trading strategies. And so they came up with this approach to sort of mitigate that, while still getting alpha versus or outperformance rather versus the benchmark. And so like comparing these equity ETF, like to Sean's point before, you get diversified exposure, right? But with direct indexing, you're getting, the ability to defer gains, right? And pass losses through charitable gifting capabilities, right? To isolate stocks that are highly appreciated and then transferring stocks in kind, right, out of the portfolio if you need to. With the taxable long short, right, you're also, seeking to outperform the benchmark, not necessarily track the benchmark and get your alpha from the sort of tax component, but to outperform the benchmark because you've made these high conviction long and short bets that if they're correct, right, your high conviction longs, right, would outperform. The tax benefits, are meant to be delivered on an ongoing basis, whether the market's up or down, right? You're going to have, those directional bets, the long and short extensions that are either, making money or losing money. And that means that you can, sort of take that capital gain stacking opportunity further into the future. You're going both long and short. And there's, flexible implementation in terms of like what we use to fund the strategy. And so just a little bit more on direct indexing and tax for long short. Even when the market rises, like we said, that short extension, right, is going to generate losses. And Martin, is this the graph you were thinking about here?
Yes, yeah, I think I saw this graph preparing for the call, and yeah, this is probably a good way to kind of look at it in terms of like how the long short is able to generate losses even when markets rise and decline, because you're taking both sides of the coin, right? You're longing and also shorting. So if markets go up, your short positions you can harvest losses, but if markets go down, your long positions will generate a loss, and you can harvest those losses. But I think it's important to also note that you're not kind of like eliminating any gains, right? You're actually deferring the gains because you're harvesting the shorts or the losses, but then you're still holding, you still have the other side of the coin that has a gain. You're just not realizing it yet. So but yeah, to Sam's point, AQR, in a lot of these long short positions, long short hedge funds, they emphasize that yeah, their main strategy is to outperform the benchmark. They have their own models that they select stocks, and they try to select the stocks with the goal of try to tracking the benchmark. But there's no guarantee that that they're able to keep that tracking error consistent over time. It's just kind of whatever over time. Markets can be more efficient, and that edge can kind of diffused out. And so that's just something to note in terms of the risk. Like it's not a foolproof magic bullet, to go uh, to harvest all your losses and not pay any taxes in the future. So yeah.
And
That's
if
kind of
when people hear about leverage and taking a $1 million portfolio and turning it into a $3 million portfolio, and especially like through the lens of like the situational awareness, fund that, blew up a couple of weeks because they had, I think, 5 times leverage on. Can you speak to the risk, Marin, of using leverage in a strategy like this and how the longs and shorts sort of impact the risk of what traditional leverage might cause?
yeah. So I mean, leverage is you know it kind of it's nice because it's able to enhance your longs and shorts positions. So if market go up, markets go up, like your gains will be higher, but also like your shorts will take a hit because you also leverage on the short side. So the idea is it makes sense, because you're leveraged on both sides, so it should cancel out. But then again, there's a risk of like the individual stock selection, right? Because some of the positions may underperform more than what you intended to do. And for shorts, like technically, your downside is unlimited, right? Because if you're short a stock and a stock goes from 100 to 1,000, like you're basically unlimited losses that's available. So it kind of goes both ways in terms of like how leverage can be used. And I mean, yeah, the risk is always there, like, in terms of like blowing up accounts but AQR, they pride themselves in having good risk management strategies and being able to, and yeah, holding hundreds of positions, not just like 10. So the strategy itself is pretty diversified, but it's still like barring like a black swan event where the markets go down 50%, and then your leverage positions will definitely will probably blow out at a point. But that's a risk you have to take, or you have to stomach or be aware of, doing these kind of strategies.
I might add
Yeah,
to
I
your
would.
Sam.
Oh, go
Oh, go
ahead,
ahead. No,
Oh, go
Sean.
for
Piper,
it.
go
Yeah.
ahead.
I was just gonna add on the leverage point for AQR there. I mean, obviously, no matter which version of the strategy you pick, there is going to be leverage used, but AQR Flex does have different levels of leverage that can be employed. So that 145 strategy has a 1% tracking error, while the 200 has a 4% tracking error because there's more leverage. So as you increase in leverage, your tracking error is also increasing, which can be great. Like Martin said, can be great on the upside, but tracking error goes both ways. So that's something else to be aware of, is that with the AQR, if there is a client that is maybe hesitant to use leverage or to use too much, there are levels to this that can be used with AQR, that's a little bit more customizable, I guess you could say, to the actual client's need.
And I'll add too, the leverage isn't free, right? If there was no cost to borrow, you could juice this thing up to 1,000%, right? I mean, like you're basically just your credit worthiness is all that matters. So leverage does come at a cost, right? And so I think that's always something that folks maybe forget when comparing two products with direct index or text or long short. I mean, there's no leverage with direct indexing, so the cost is really fairly low from an operational standpoint. Text or long short, though, when you talk, say 200, 100, 300, 200, these really high levels, not only are you juicing up the tracking error kind of potential, but also much more increased cost of leverage and borrowing and whatnot. So if it would be a really, honestly, a perfect product almost if it had no cost embedded in leverage, but there is a little bit more risk and a little bit more of that cost just to get that tax alpha.
Right. Yeah, I fully agree. I think that the one of the most important parts, if you plan to employ a strategy like this, is manager selection, right? Because there's the, the starting as an alpha seeking strategy first, like outperformance versus the benchmark, right? Like that is a sequence of decisions, usually quantitative decisions about security selection, picking pairs, right? Like matching stocks. That is not easy to do consistently well over time, right? And like the black swan event, component, having taken the wrong side of the long and the short, right? Like theoretically, if you've got, a third of the book that's, sold short and the market goes down, that should help you versus just a straight long with leverage strategy, right? That would theoretically be subject to a margin call or capital call. But if you took the wrong side, of that, and like there was just adverse security selection because the manager selection wasn't, done appropriately, that it could get dicey. So I think, on this subject, it can be, especially with higher levels of leverage, a tax loss harvesting machine, but not without cost and not without risk, uh, as you sort of assess it as part of your broader plan. Okay, so moving on for the sake of time, and thank you guys for pitching in there. One thing that is very often coupled with a tax-aware long short is what's called a variable prepaid forward contract, or what our friends in the options world would call a collar advance. And so, Brett, would you mind bringing us up to speed on variable prepaids?
Yeah, for sure. Thanks, Sam. So the variable prepaid forward, it sounds really complicated, and there are some complicated components to it, but at a very simplified level, what is it doing? Well, it takes your concentrated position and it's collaring it, which we'll go through here in a minute. And a collar, just to give a quick example, is let's say your concentrated position is trading at 100, the stock price. It would put a floor at, say, 90 or 85. You get to select it. And if it's at 90, you would have all the downside to 90, but then you're protected below 90. Now, in addition to the floor, it also has a cap on the upside. So maybe the cap is at 120. So meaning you have all the upside from 100 to 120, but then you're capped out above 120. So if it goes to 130, 150, 180, you only capture the value up to 120. So that's part one. It collars it, but then the key part of the variable prepaid forward is you get a loan off of your position. And this is really the only reason to do a variable prepaid forward, is for the monetization of your concentrated position. So you get that loan. What's attractive about the loan? Well, there's a few aspects to it. So the primary one is that you get a very high loan to value. Typically, how we set it up, that loan to value will be around 75, 80% loan to value, which is a lot higher than you can with just margin. Margin from a custodian will give you 50% margin release, but you can't use all that because your stock goes down, you're already in a margin call. So again, that 75 to 80 is a very high level. The other key aspect is that it's effectively a very low interest rate. They're loaning you money at basically Fed funds or SOFR plus just a little bit. Those are kind of the overnight rates. So right now, what I've seen on recent variable prepaid forwards, the rate's been at about 3.75, 3.8%. So really attractive to what us in the real world can get a loan at. So that's the key reasons of why do this. Now, when you get that loan, theoretically, you can do anything you want with that loan. You go buy a house, a boat, but most people are pairing this with the strategy we just talked about, or Sean's direct indexing strategy. So with the tax-aware long short or direct indexing, the beauty of pairing them together is you can put this variable prepaid forward on your stock, get that loan, invest in this other strategy, and then by the time you sell it, call it 2, 3 years later, you've likely generated enough losses to largely offset or completely offset the tax ramifications for when you do sell your stock at the maturity of this forward contract. So again, like what was already mentioned, it doesn't eliminate the tax liability, but it's deferring it. And how I like to think about it, it's taking your concentrated stock position with a low basis and basically transforming it into a diversified portfolio, which will effectively have a low basis by the time you get to that point. So again, it doesn't eliminate it, but to Sam's point at the very beginning of the call, what are we using these tools for? A lot of times it's for that diversification, right? And he went through all the statistics.
Absolutely. Yeah, I think like pairing and marrying these things together, variable prepaid forward unlocks the liquidity, it puts a floor under the stock so that your loan doesn't get, upside down, 2 or 3 years from now. Right. And then just like we said, you implement a tax-aware long short, give it a 3-year run cycle, you may be able to wipe out the capital gain at the eventual sale. Couple that with some direct indexing, because typically, your tax-aware long short, like with AQR, it's going to be Russell 3000. We don't, you're not going to have any international or emerging markets exposure, or, what we would want in a, fully diversified portfolio. We can get that through the direct indexing sleeve, right? And now you've got a, fully globally diversified, portfolio that's seeking tax alpha ahead of that ultimate sale. So very, very powerful combination of tools. And so moving into options, I think just briefly on this subject, what's a call and a put, right? So a call is the right to buy a stock for a predetermined price. A put is the right to sell a stock for a predetermined price, right? And you can buy or you can sell calls and puts. And so through that lens, we're able to use these vehicles or these securities to either generate income when we're selling them, right? Or to uh, sort of demonstrate a bullish thesis when we're buying them in the form of calls, or to add protection to the portfolio for buying them, right, in the shape of puts. And so, with that sort of entree, Brett, talk to us a little bit about covered calls and the collar strategy.
For sure. So the covered calls, this is what I would call is the most popular strategy, probably utilized by clients with a concentrated position. Now, what is it? Well, covered means you own the stock and then you're selling the call option. What's a basic example? Again, let's say your stock's trading at 100. We may go out and sell a 115 or 120 strike call. That means you'd have all the upside to where we set that strike price. Let's call it 115. So you'd have the upside from 100 to 115. But if it goes to 130, 150, 200, you're effectively obligating yourself to sell it at 115. Now we do manage this. We can exit that call and roll it higher and get clients higher than just that initial price. But point being that you have to be willing to sell. The number one rule that I have with this strategy is this is a great tool to tactically get out of a concentrated position over time while controlling for taxes. What do I mean by controlling for taxes is we can control how much we sell in any given year to control that tax burden. So maybe a client only wants to realize up to $250,000 in capital gains in a given year. We'll take those instructions and manage the strategy accordingly. But we don't want to do this on shares that a client doesn't want to sell over the next 2 to 3 years. So let's say somebody has a $10 million position, but they are only willing to sell, call it 3 million, a million per year over the next 3 years. Well, we would only want to take on 3 million of that 10 million. We would not want to sell calls on the entire $10 million position. So again, a great tool to tactically get out of a stock over time. And if you set it up correctly, it is a win-win, right? This is like somewhat like, for those of you familiar with a limit order, it's kind of somewhat setting a limit order to a higher level. If it doesn't go up and hit that limit order, if you actually had an actual limit order, no harm, no foul, it didn't execute. But here, if it doesn't go up, well, you get paid. You get paid that option premium to wait for it to go to those higher prices. So it's a nice tactical way for people who aren't really wanting to sell now, to say, hey, yeah, I'm willing to sell. I'd like to wait for it to go a little higher before I sell. And oh, yeah, would I like to get paid for waiting? Yes, perfect. But if you're wanting to sell now or you're never wanting to sell, it's not a good solution. But for those who can be a little more patient, it can be a really good solution.
Yeah, you can set your price and get paid along the way in most cases. And so let's talk a little bit about collars as an alternative to covered calls.
Yep. So the collar, as we discussed, is embedded in the variable prepaid forward. But again, the variable prepaid forward, the only reason to ever do that is for the loan because we manage a lot, literally hundreds of collar accounts with collars. So the collar, we can set up the collar and customize it for our clients here internally. Now, the collar, very similar to the covered call from the standpoint of you sell that call option, right? The covered call, we're selling the call. The covered call, you get cash when you sell it. The difference with the collar is we don't keep that cash. We take basically that same amount of cash to go buy that put. So let's say we
Oh, looks like Brett's freezing up.
usually
There he is.
we don't use quite all of it, but then we go use say $9.50 of that $10 and buy a put. So overall, it protects you on the downside, puts a floor on the downside, but you have a ceiling on the upside. And the same parameter still applies in that you need to be willing to sell if that stock really goes up because it has that same upside risk.
Yeah, but buying portfolio insurance is expensive just off the rack, just buying
Yep.
puts. The collar gives you the ability to finance the cost of that insurance, so long as you're willing to accept that that higher strike price, you need to be willing, to ultimately sell. But it's a great way if you're concerned, right, about a stock price falling, to put a floor, underneath the stock and not have to, pay really, really significant expenses to do it. And then I'll just briefly on this one. So, options are fascinating tools in finance, and you can use them to essentially, create predetermined outcomes, predetermined prices for sale, and predetermined prices, for purchase, right? And what that results in is strong collateral, right? Like these are contracts, right? And if you have a predetermined outcome, a sale price, right? You can use that as collateral to then access liquidity, either in the variable prepaid forward contract, or another version, which I don't think we'll have enough time to really dig into today, which is called a box spread loan, an alternative to a securities-backed line of credit, with typically lower interest rates. So options, if you've got concentrated positions, options should definitely be part of your sort of tool belt and what you're considering in terms of using. Okay, next up, Piper, can you fill us in on how the exchange fund products work?
Yeah, so exchange funds work a little bit differently than some of the strategies that we've already talked about, and that it solves this concentrated position issue primarily through tax deferral rather than through generating losses. So the client would contribute an appreciated stock into a partnership with other investors, and in exchange, the client receives an interest in a diversified portfolio without selling the stock and immediately realizing the embedded gain. So the major benefit of this is the immediate diversification, in that you're contributing this position, you are getting immediate diversification of this underlying portfolio. But the trade-off is that you're giving up control over that individual stock. And instead, you're owning an interest in this pooled portfolio that's managed according to the manager. We use Goldman Sachs in our case, but it's benchmarked to the Russell 3000. So you kind of have a little bit of that trade-off of performance as well, which is generally, if you're going to contribute an appreciated position to this type of fund, that's what you want. You want less volatility, you want more benchmark-like returns. That's the benefit of this type of strategy. But the liquidity profile is also pretty different from a long short or direct indexing solution. So exchange funds generally have a longer holding period. This one is around 7 years. And after that 7-year holding period, you can redeem that diversified basket of stocks for 25 to 35 securities. And then you would receive that at the fund's net asset value in the form of those originally contributed securities, and then supplement, or if you do that before. So if you redeem prior to year 7, you would get your stock back at its basis. And if it's before year 3, there's also a little bit of a haircut. So the client would really need to be comfortable with that illiquidity and understand that while you are getting immediate diversification, that immediate diversification doesn't come with immediate liquidity. So that happens over time, but after year 7, then you're able to redeem at the fund's NAV. You receive 25 to 35 diversified positions. The caveat I would say with this is that the fund has to have capacity for the security that the client wants to contribute. So while this can be a really strong solution for specific clients, typically big names like an NVIDIA, Microsoft, Broadcom have limited capacity, and capacity moves fast. So this is something that you need to, if you are wanting to use an exchange fund, that you want to work pretty closely with our team or with Goldman Sachs directly to understand where capacity is at before pitching it to a client or telling a client that they're able to contribute, since it is on a first come, first served basis, and bigger tickets get priority. So, and capacity moves around all the time. So
Yeah.
that's the one caveat that, I mean, it's less immediate or customizable than like a direct indexing or an AQR strategy where you're able to kind of build around what you have. This, you kind of have to be able to slot your appreciated position into what Goldman Sachs or the exchange fund is offering at that point in time.
Yeah, that's great, Piper. Thank you. When we talk to clients about these, this is money that you don't need for the foreseeable future, right? Like it's this, you don't want to try to redeem prior to the 7 years. It's got to be the real long term money. But to Piper's point, you're getting the immediate diversification, right? I mean, it's with the other strategy aside from like the outright sale, um, it's difficult to get that immediate diversification, and of course there's cost that comes with it, and the sort of illiquidity, the cost of not being liquid, which is not exactly quantifiable, but this is something that you want to do some really in-depth financial planning around, so that you can confidently say, I'm not going to need these funds for at least 7 years before I'd receive that basket of diversified positions that you could then begin to unwind or incorporate into a direct index model or something else. Um, and also to Piper's point, like the demand for the stock that you own might not be there. And like, you might think this is a good option, but like there's supply and demand, issues at play here also that might eliminate this as a potential option that you could even consider depending on the environment. So thank you for that, Piper. All right, so as we kind of get through the end here, we always tell folks, you concentrate to grow wealth, diversify to keep it, right? And then we look at that from a risk management perspective and also a goals-based perspective. And so, I've got on here, depending on your goals, what are some of the different strategies that you might consider? And I think the key takeaway here is that there is no silver bullet. There's no right answer, right? Like your right answer, so to speak, is going to be a tapestry of strategies, right? Like a collection of strategies that are all working together to accomplish the goals, right? Like the actual real life outcomes that you're trying to accomplish. And so we put together a couple of examples in terms of case studies. And so this example, we're showing, this highly appreciated stock, right? $8.6 million, $190,000 of cost basis. And the outright sale, in this example, it's a California tax rate, capital gains rate, net investment income tax rate. It's about 37.1%. People always think, oh, I only pay 20% of my capital gains. Well, not always, right? You got to put the state in there, and then you also usually, if you're at 20% of net investment income as well. But in this scenario, that 8.6, right? 8.469 of its capital gain, which means at the state level you owe 1.126, and at the federal level you owe a little over 2 million. So your 8.6 net of tax is really like 5.518. So thinking through a collection of strategies, what if we folded in, for this person, diversification and passive income was the primary sort of driver here. And we wanted to diversify $7 million, right? And keep about 1.6 for what we call, the FOMO bucket, which, everybody to some degree has, in case the stock just goes, through the roof. But in this example, we said, hey, what if you did a NIMCRUT for 3 million, right? That would get you 300,000 of itemized deduction, right? Which at this tax rate illustrated is worth about $147,900 of reduction in tax. At a 6%, payment rate that's illustrated, it's 180,000 of income you could pull out of that NIMCRUT and use for, whatever reason, from that point forward. Take 2 million to an exchange fund, assuming that they're, the demand and supply, economics are there to receive it, diversify it right away, and then go ahead and sell 2 million, right? Just, outright sale. Bunch of capital gains tax that's due, right? But we did pick up the deduction from the NIMCRUT to reduce that a bit. And so those 2 million, the net proceeds become 1.4. Now, this isn't in, taxable or long short. This isn't like a direct indexing and sort of muni bond, allocation, hyper tax efficient allocation. We can then put a line of credit on there, right? So if we're using 50%, somewhere in the neighborhood of 700,000, you'd be able to access without selling these positions, which the analysis here is saying that would be a 20% down payment on about a $3.5 million home. And then holding shares, right? We hold the 1.6 and probably put some cover calls or a collar on them, right? Just to sort of either protect the downside or, maximize their value through the cover call income. And where do we end up, right? So, the portfolio value is 8,083,000 versus 5,518,000, right? We would have paid 577,000 in tax, right? Capital gains minus the deduction that came from the CRUT. versus, in this case, it's like 3.1 million of tax. We would have picked up these payment rates, 180,000 a year. And you also, would have had 300,000 of your, aggregate uh, uh, portfolio that's going to go to charity ultimately, right? Because that's the deduction you took on the NIM credit. So I got a couple more of these. In this version, we're not using the CRUT. Instead, we're using that combination variable prepaid forward, right? So $4 million, all this is the same information over here, but $4 million contribution. We're assuming an 80% floor. So we bought puts, right, to protect 80%. And if anybody needs to jump, by all means, I know we're going a little bit long. So if you guys need a jet, no problem. So, 4 million of variable prepaid forward, that's going to get you 3.2 of liquidity, right? So 80%, 2 million to the taxpayer long short, and then 1.2 going into the direct indexing model. From there, we do a little bit of philanthropy, right? So 300,000 a contribution to a donor advised fund. That's going to get the same tax deduction as the NIM credit because it's the fair market value, not 10% in the other version of what went in. And then an outright sale of 2.7. And so that 2.7 generates a bunch of capital gains, right? We've got capital gains tax of 979. We got our deduction from the donor advised fund contribution. We've got our net proceeds there, 1.8. Add that to what we got from our direct indexing on the variable prepaid forward. And we've got about a $3 million portfolio in the direct indexing model, 2 million in the taxpayer long short. We can then get a line of credit on that 3 million for about 1.5. That's a representative of a 20% down payment on $7.6 million property. And then keep the same amount for FOMO with an option strategy. Where do we end up? Still $7 million of diversification, right? A chunk of that is, of course, in the donor advised fund. It's diversified, but you can't call it back. Portfolio value 7.5 if we omit the donor advised fund. Taxes are 800 versus 3.1 million, and sort of end all be all is 5.5 million value of an outright sale, 7.5 million in that scenario. And then one more kind of bringing up the NIM credit, variable prepaid, and the outright sale together. Same information on the left hand side. Still targeting 7 million of diversification, 3 million to the CRUT, 180,000 of income payment rights, 147.9 tax deduction, 3 million to variable prepaid, right? It's 1.5 to tax aware, 900 to direct indexing, outright sale of $1 million. Pay the tax, get some benefit from the CRUT, end up with the portfolio value of about 1.7, right? That'll give us a line of credit for about 842, representative 20% down on 4.2 million. But where do we end up, right? 7 million diversified, portfolio value, 8.445 versus 5.518. Tax owed, 214,000. 362 due on the outright sale minus the benefit from the CRUT. We've got the income at 180, 6%. And then the philanthropic piece, the amount of the deduction that we took on the NIM credit. So I think the key takeaway is, again, it's a tapestry of strategies, a collection of strategies to reach your goals. And depending on what those goals are and getting clear on what the goals are is really, really the first step. And so with that, I don't see that we've got a bunch of questions in the chat. I will then take this opportunity to thank all of our panelists for their help. Really appreciate it. And then to thank all of our clients for their business and more importantly, for their trust. If this resonates with you and you want some help on a concentrated position, please reach out. Contact info is here. And if you know anybody that might benefit from this information, feel free to share this recording with anybody that might make use of it. So thank you again, and we'll see you on the next webinar.